the United States through the IMF and World Bank, they've discouraged countries from having gold. I think, isn't it the IMF, Paul, or the IMF even? Yeah, they don't allow member countries to back their currency with gold.
Yeah.
So, but now China is saying, well, we don't want to be part of this. We want to use gold and we want to back our currency with gold. And COMEX is not a physical market, even though this year there's been a lot of physical activity. The other thing is, I think China has a lot more gold than the 2,300 tons that they officially publicize. And yeah, so that's how you can, and maybe, yeah, that's how you back the yuan.
MarioInnecco highlights how institutions like the IMF and World Bank have long discouraged countries from backing their currencies with gold. The IMF does not permit member states to officially peg their currencies to gold. However, this stance is being quietly challenged as countries like China begin exploring gold-backed settlement systems and alternative gold markets, notably through the Shanghai Gold Exchange. China's efforts are part of a broader regional shift away from the US dollar. Across Asia, nations are gradually reducing their dependence on the greenback, driven by ongoing geopolitical tensions, evolving monetary policies, and a growing preference for currency hedging. In line with this trend, the Shanghai Gold Exchange has recently expanded beyond mainland China for the first time, launching new gold contracts and establishing a bullion vault in Hong Kong. This move aims to provide an alternative gold pricing and trading mechanism, independent of Western institutions such as the COMEX and the LBMA. At the same time, central banks around the world, which are responsible for managing trillions of dollars in reserves, are increasingly rethinking their strategies. A forthcoming report from the Official Monetary and Financial Institutions Forum, OMFIF, reveals that 1 in 3 central banks managing a combined $5 trillion plan to increase their gold holdings over the next 1 to 2 years. This is the strongest such signal in at least 5 years, reflecting a growing desire to diversify away from the US dollar in favor of gold, the euro, and China's yuan. Innecco also raises concerns about the reliability of major Western gold exchanges. If multiple countries were to demand large-scale gold redemptions from the COMEX or the LBMA, he argues that these institutions would likely struggle to fulfill them. Earlier this year, the LBMA reportedly experienced near-default conditions, with gold delivery times stretching from the usual 3 days to as long as 8 weeks. These logistical strains further support the growing push for decentralized gold-backed systems and independent infrastructure outside traditional Western frameworks. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
I think the Bundesbank and probably the Bank of Italy, they're probably not too concerned. It's like more the European Taxpayers Union. They are concerned, and a lot of politicians in Germany are concerned about it too, and also in Italy, especially the ones on the right. So I think pressure could increase on the German government, the German central bank, and same with Italy, to repatriate the gold that's left at the New York Fed. I don't know if you remember, Paul, I think some years ago, before 2020, Germany asked for 300 tons from the New York Fed, and it took them 3 years to ship that. They still have 1,200 tons with the New York Fed. The New York Fed also is a private institution, so I would be concerned. So I think it is for security reasons, because the current administration and also previous administrations, is not just Trump, they've used the dollar and the banking system as a tool, as a weapon for politics. And I think it doesn't get any more important than gold, because as Greenspan said once, when there's chaos and turbulence and war in the world, there's only one way to pay your bills internationally, and that's gold. So I think we haven't heard the last of this. And I think it could really squeeze the market higher, because I think the Fed dragged its feet last time for Germany, because I think they use a lot of the other people's gold to lease it out. So they had to they couldn't send it back straight away, because they had to go into the market and buy it very slowly in order not to let prices go up. So the United States through the IMF and World Bank, they've discouraged countries from having gold. I think, isn't it the IMF, Paul, or the IMF even yeah, they don't allow member countries to back their currency with gold.
I think that's the case. Yeah.
But now China is saying, well, we don't want to be part of this. We want to use gold and we want to back our currency with gold. And COMEX is not a physical market, even though this year there's been a lot of physical activity. COMEX was created, if you look at the WikiLeaks file from 1974, the Treasury Secretary, the Secretary of the Department of Treasury, excuse me, the Department of State, and the bullion dealers in London decided that the best way to make sure Americans didn't buy gold and hoard physical gold was to have a futures market. So that's what the COMEX is for, and to some extent the LBMA. Is that the way you see it too, Paul? And do you think Shanghai Gold Exchange and also other physical exchanges are chipping away at this paper game? Who don't seem to understand that this is not for like retail
No.
investors. This is between sovereign countries. Aaron White says, that's his comment. He says, if this is gold backed, then so is the dollar because you can take your dollars to the COMEX and buy gold with it at the market. And he's saying this is the dumbest conversation. But have you ever tried to take delivery on COMEX? And do you think COMEX would deliver tons, thousands of tons to China? I don't think so. So COMEX is not a physical market. And like Paul said, it's rehypothecated. And so is the LBMA. That's why the LBMA early this year in January, when Americans were trying to get physical gold from the LBMA, the LBMA was basically in default because their spot delivery, instead of being T plus 3 days, it was T plus 4 to 8 weeks. Back during the gold standard in the 19th century, yeah, the pound sterling was the major reserve currency, was the main currency. And it was basically the banking system in the UK kept about 33% of the money supply, or the whole credit system was backed by gold. And it doesn't have to be 100% because you buy and sell between countries, you make a small profit and then you have a surplus or a deficit, so you don't have to have the full amount. And the other thing is, I think China has a lot more gold than the 2,300 tons that they officially publicize. And yeah, so that's how you can, and maybe, yeah, that's how you back the yuan. What it means is that whenever you have a surplus with China, you can either take those yuan and buy Chinese goods or invest in China, or you can also go and get your gold. And that hasn't been the case since the early 70s when Nixon closed the gold window. They've encouraged people to hold on to debt, to treasuries. And I don't think that's what the Chinese are encouraging people because they want to get off this. Maybe some people will hold Chinese government bonds, but I think they're focusing more on gold. A lot of people here are asking, oh, how, what good is it to peg a currency if you have to unpeg? But as Paul said, they're not going to try to peg it. They're just going to leave it floating at the market. I mean, I had heard of this as well, Paul, that they're even thinking the Shanghai Gold Exchange, that they're trying to open also a depository in Saudi Arabia. I think they could
That's true.
open, yeah, elsewhere as well, the countries that they trade with the most. But what I would say as well is that eventually, if this gold settlement system increases, I would say that the relationship between the yuan and gold and other currencies and gold is actually probably going to stabilize a little bit. And it's maybe they're doing it the other way. Instead of fixing the price, they're just going to let the market and trading conditions set like a band.
MarioInnecco notes that Russia has been quietly accumulating silver, platinum, and possibly palladium, not in overwhelming quantities but enough to attract attention. While silver has not traditionally been a primary reserve asset for central banks, that may change if prices surge into triple-digit territory. In such a scenario, silver could become a more strategic holding, prompting broader diversification into the metal by central banks. Silver is increasingly positioned for a significant breakout. Analysts are eyeing ambitious targets, with some projecting prices could climb as high as $250 or even $500 per ounce over the long term. While such levels would likely require extreme economic conditions, such as acute physical shortages, aggressive rate cuts, or runaway inflation, more immediate milestones like reaching $100 are starting to enter the realm of possibility. Momentum continues to build as investor sentiment shifts in anticipation of significant fiscal and monetary policy moves. The quicker former President Trump's proposed Big Beautiful Bill is passed, the more likely it becomes that the Federal Reserve will resume large-scale money printing. This would further debase the dollar and add fuel to precious metals markets. As history has shown, silver tends to follow gold's trajectory, often with greater volatility and upside. Renowned market analyst Michael Oliver, known for his momentum-based technical insights, is also extremely bullish on silver. He forecasts that silver could rise sharply by year-end, eventually targeting a price range between $100 and $200 per ounce. For investors, these forecasts suggest that the current market environment may be the calm before a powerful rally in silver, driven not only by inflation and policy, but also by growing institutional interest. Let's get back to the interview.
Someone also commented about the UK gold reserve. It's only 310 tons, but the Bank of England holds about 5,000 tons, but that's for other countries. And I guess, Paul, possession is the old saying is possession.
Yes, 9/10 of the law.
9/10 of the law. So I guess that's the only saving grace for the UK. But not really, because the Bank of England is really not. I don't really think the Bank of England operates for the good of the UK. They operate more for the good of the bankers in London. So I don't think it makes much difference. So they'll never use that other country's gold really to help the country itself. They'll probably use it to save their own skin. Is that the way you see it? Someone is asking here, Paul, will accumulation of silver by the Russian central bank spread to other central banks? Yeah, I saw last year they announced they're buying silver and platinum as well, I think, or could be palladium. I don't think they're buying huge amounts, but who knows? Yeah, maybe silver will be accumulated by central banks, especially if the price goes up a lot to like into triple digits. It could be a good reserve to have. I don't know. I saw Bert Doman. He's an older gentleman. He was born in Germany during the war. And he's been an investment advisor for like since the 70s, and he got into gold in the bull market. He got out in 1980, and he recently spoke to ITM Trading, to Daniela Cambone, and she asked him about the US gold, and he thinks that they actually ran out of all the gold they had, and that's why Nixon had to close the gold window. So he doesn't think they have any. And the thing that he said that makes sense is if they had all that gold, why can't they just do the audit? It's very simple. The other thing Bert Doman talked about, which is interesting, when the war ended in Germany, he was only a boy. And he said his parents still had these coins here, the Maria Theresa thalers, which were very popular, silver coins. And he said they were able to survive because they had silver coins. And he said the kids in Germany post-World War II, with the rubble, everything, they used to basically go metal hunting, from all the destroyed buildings, and they used to make survive because they used to sell all the metal to the scrap dealers, and they could. That's the thing that worked. I'm not saying we're going to be in the war and have rubble around, but I think there's a really good chance of currency collapse, Paul. I notice everything seems to be getting more and more expensive, especially the stuff that we need to survive, like food, energy, water, and many other things. And I think what's going to happen is, yeah, I'm not sure the central banks will rein in the money printing. How do you see it? Do you think we're going to have? I think hyperinflation is just like a deflationary collapse. It sounds counterintuitive, but it's the way to, instead of destroying debt by defaulting, you destroy debt by collapsing the currency. And most people think that it was just the French who, sent battleships to New York Harbor to get the gold, but the British wanted their gold too. And I think they only got half of the gold that they supposedly could get. There are two things that they could have done, and I've read this because John Exter of Exter Pyramid fame, he used to work for the New York Fed, and at the time it was Paul Volcker. He was Undersecretary for International Affairs at the U.S. Treasury, and he was a friend of John Exter. And he asked him for advice, and John Exter said the way to stop the gold flowing is either to raise interest rates. Well, he said there's three options, I think. Raise interest rates and you stop the gold flowing out because people will want to hold the currency more and get more return. Or you devalue the dollar, right? So you don't have to pay out as much gold. Or you default. And they chose the default because politicians never want to raise rates. For the US, there's all this doubt. And it's not just like people that are not in the US that doubt this 8,000 ton, well, it's 8,130, I think, ton amount. Americans as well. I mean, even Trump some months ago questioned it, and there's all the talk by Elon Musk that we're going to do an audit, but that's gone out the window. And in China, the speculation is that they have more. So yeah, it could be have a huge impact. I'm not sure China would care because just by announcing, or maybe they won't announce like Paul said, but the more China becomes important in the gold market, I don't think they really care. I think the price of gold will tell the story. I'm not sure they're into like this kind of how can I say, yeah, show us your gold and things like that. I know the mainstream media is fake news. So, and I agree with a lot of the stuff that Trump has done and says, but at the same time, I think a lot of his his comments about China is more for domestic consumption. I also think that the United States, they want to have good relations with China because we saw recently, Paul, that they had to kind of back down on some of the tariffs because the Chinese said, well, if you're going to do that, we're going to not ship the rare earth metals that you depend on from us. And the reason China has a lot of 95% of rare earth metals, like mining and production, is because the West basically abandoned because of this what's it called? Environmentalism.
Yes.
Climate change. They don't want to mine for real things, and China did. So it's a little bit, and I think Trump wants to get that back. He has signed executive orders that he wants to dig, or drill, but that's going to take years it's going to take at least 5-10 years to get it up and running.
Stirrings beneath the surface of the global financial system hint at an evolving order, where gold and silver are reclaiming strategic roles once thought obsolete. As nations recalibrate reserve strategies and experiment with alternative monetary frameworks, the foundations of dollar dominance are showing signs of strain. From expanded regional exchanges to delayed bullion deliveries, a quiet shift is accelerating, one driven by both necessity and foresight. Meanwhile, silver's trajectory is being reimagined no longer as an industrial metal alone, but as a potential linchpin in a new reserve paradigm. Could this rising tide of de-dollarization and metal-backed systems signal the dawn of a parallel monetary architecture, where silver and gold serve not just as hedges, but as anchors as well? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.